at the three major averages, a bit of a mixed reaction that we were seeing at the open. If we go throw up the three major averages here, all right, we have all three of the major averages actually moving to the downside here. The Dow off 0.1%. You've got the S&P off 0.1% as well. The Nasdaq also a bit of pressure. The move lower coming as inflation does in fact remain sticky. Producer prices rising 2.4% from a year ago. That was slightly hotter than what the street had been anticipating. We want to bring in Brent Schutte. He is the Chief Investment Officer at Northwestern Mutual Wealth Management Company. And we also have Kevin Flanagan, head of fixed income strategy at WisdomTree. Guys, a lot to get into here this morning. Brent, let me start with you just in terms of the market's reaction here this morning. A bit of a reversal. Looks like the market is taking a bit of a breather. Should we be reading any further into today's action?
No, I don't think so. You've come a long way in a short period of time based upon hopes of what could possibly be in the future. And I think now it's more of a show me. The reality is inflation remains high. It remains sticky. The Fed's job is likely not done. And even though they've cut by 75 basis points, I know that the 10-year Treasury has risen by 85 basis points. And so that's the riddle going forward. How does the Fed, how do rates move lower and help parts of the economy that haven't done well because they've been impacted by rates? And that's the riddle going forward. And I just think it's time for a pause in the stock market.
I want to get your take on this too, Kevin, from a yields perspective. We obviously saw yields moving higher on the back of that PPI figure. Is the Treasury market telling us a growth story or flashing a warning signal about inflation?
Well, I think it's a little bit of both, right? I mean, the narrative that we had during the summer when the 10-year rallied about 100 basis points, none of that was validated. And we continue to see a resilient economy, a labor market that's not cooling as expected. And to your guys' point, inflation kind of getting stuck right here. You know, if you look at core CPI, the numbers last 6 months between 3.2, 3.4% year over year. So I think what the market's telling you is that, hey, this rally wasn't validated, and looking ahead, you know, some concerns that perhaps if in fact the red sweep produces what Trump was talking about, some of those policies are being viewed as inflationary.
Are you viewing them as inflationary, Kevin?
Nah, you know, we have such a long way to go. You know, I don't want to get ahead of myself with that. I mean, legislation takes a long time to pass, right? We don't know what we're going to get from that. So I would think at this stage of the game, at a minimum, it's kind of neutral to maybe pro-inflationary.
Well, something else that is a factor in the inflation discussion is, of course, the deficit, top of mind for a lot of investors, especially as we know Elon Musk is attempting to tackle $2 trillion in costs in his new role. Details remain to be seen, but economists expecting President-elect Trump's tax cuts to be a little bit of a ballooning factor for the deficit. We spoke with experts at Yahoo Finance Invest about the outlook for the deficit. Here's what they had to say.
We are, at the moment, running circa a $2 trillion deficit. We've waited too long to fix underlying problems so that small amounts of tinkering are unlikely to result in directional change.
I think getting the balance right of spending containment, tax receipts, clarity and getting the condition there, whether it's cutting rates or simplifying the code and generating other ways to make sure you have it. But you need more revenue, and you also need to manage expenses. There's no other way to do it.
The long end of the yield curve, to me, is where you got to be really, really careful and really thoughtful about it. We go through auctions, you know, sizable Treasury auctions, almost every day. You got to instill confidence, and I watch these auctions, particularly further out the yield curve, like a hawk.
So, Brent, I want to go to you on this. If we have investors who are watching Treasury auctions like hawks, sussing out when the deficit issue is going to become a problem within the Treasury space, when does the sort of lift that we continue to see in yields become a problem for the rally we're seeing in equities?
I think it will become a problem just because right now, if you look at bonds and you look at the earnings yield of the S&P 500, the earnings yield of the S&P 500 is below bonds, which historically there have been periods of time where that hasn't been an issue. That's been because bond yields were moving lower at the same time. Look, to me, right now, if you look at the stock market, the S&P 500 trades at expensive valuations. It doesn't trade at valuations that make sense with a 4.5% 10-year Treasury yield. And so either the Treasury yield has to move lower or valuations have to either be grown into by earnings growth or pulled back. And that's where I think the conundrum going forward is. And I think investors, despite the reality that, yes, deficits are becoming more and more of an issue, I think they still need to invest in fixed income, because I do think it's something that's going to have to be dealt with, which we can as a country. And that's where I think there's still opportunities across the yield curve, not just at any one point, not in just hiding in the front end. Who knows what happens in the future, and just make sure that you have treasuries across the curve that match the duration of your liabilities or when you need those.
But Kevin, in terms of utilizing what we're seeing in something like Treasury auctions to suss out the health of the economy, are there any risks ahead that you're concerned about?
Well, I think you need to put the deficit and attendant increase in Treasury supply kind of in some perspective. Usually what we've seen over the course of at least, post-war modern financial history, it's the macro, it's the Fed, it's inflation. That's the primary driver for interest rates. The deficit, supply, secondary or tertiary. Perfect point. Last 12 months, we've had 2 different rallies in treasuries worth 100 basis points with record coupon supply and, as we heard before, baseline $2 trillion deficits. So that's the point that I was kind of making before too. How do we get from 2 trillion to 4 trillion? I don't know if we're going to get there, right? So much has to be filled in on the legislative front on that backdrop. And to the point, watching auctions, yeah, we should be watching auctions, but I don't think we're going to see any failed auctions going forward. But could the bond market send a signal, a shot across the bow that, hey, you guys need to calm down a little bit here, and we go to 5% or somewhere around there, or maybe above on the 10-year Treasury? That's what I'd be watching for, that kind of a signal.
So, Brent, given all this and given the fact of where we are, current valuations right now may be a bit stretched to some at least, how should investors then be approaching 2025?
I just think a little bit more of a caution and a reality that no one knows exactly what's going to happen for sure. Look, I believe in diversification. We believe in diversification. And this is the point in an economic cycle, which I think we are later in an economic cycle, where investors are tempted to concentrate in one particular asset class or a narrow sliver of an asset class. And that historically has led to disappointing returns in the future. And so stay diversified. Understand that while large cap stocks are expensive, there are opportunities in small and mid cap stocks. And that fixed income, if you need the money in the near term, despite the deficit worries that I have and that others have, is still a good asset class as long as you remain more towards quality.
All right, Brent, Schutte, always great to have you. Kevin Flanagan, thanks so much for hopping on with us here this morning.